Part 1. What is Bitcoin really? Bitcoin is not a stock. It is not a payment app. And it is definitely not a shortcut to getting rich. Bitcoin is a digital monetary asset. This distinction matters more than most investors realize. Stocks represent claims on future cash flows. Payment apps are distribution layers built on top of existing monetary systems. Bitcoin is neither. Bitcoin does not promise earnings, dividends, or utility in the traditional sense. Instead, Bitcoin exists as a non-sovereign monetary system with rules that cannot be altered by political pressure or economic emergencies. Unlike fiat currencies, Bitcoin has a fixed supply. Only 21 million coins will ever exist. No central bank can print more. No government can change the rules. This is not a design choice. It is the core of Bitcoin's value proposition. In the traditional financial system, money supply is elastic. During crises, central banks expand balance sheets, inject liquidity, and lower interest rates to stabilize growth. This flexibility keeps the system alive, but it comes at a cost. Over time, purchasing power erodes. Monetary discipline is sacrificed for stability. Bitcoin takes the opposite approach. Its supply was locked in from day one. No bailouts, no emergency stimulus, no discretionary policy. This makes Bitcoin fundamentally different from every fiat currency in existence. It is the first monetary asset with credible enforced scarcity in a digital world. But a fixed supply alone does not guarantee price appreciation. This is where many investors misunderstand Bitcoin. Bitcoin's price is not driven primarily by adoption narratives, technological upgrades, or short-term headlines. It is driven by global liquidity. When interest rates are low, money is cheap. Capital flows outward along the risk curve. Investors search for assets that offer asymmetrical upside, protection from debasement, or both. In these environments, Bitcoin benefits. When liquidity tightens, when interest rates rise and capital becomes expensive, Bitcoin struggles. Not because its fundamentals change, but because liquidity is the fuel that drives macro-sensitive assets. Bitcoin does not trade in isolation. It trades inside the global financial system. This is where many retail investors get it wrong. They focus on narratives, adoption stories, or short-term news. They ask whether Bitcoin is being used more. The real question is whether global liquidity is expanding or contracting. Bitcoin behaves less like a startup and more like a macro asset. It reacts to interest rates, dollar strength, and financial conditions. It thrives in risk-on environments and struggles during risk-off regimes. This does not make Bitcoin weak. It makes it honest. Bitcoin exposes the true mechanics of the financial system. It reflects how money flows, how risk is priced, and how confidence shifts across cycles. In this sense, Bitcoin is not just an asset. It is a mirror of global monetary policy. To understand Bitcoin properly, you must stop looking at it as a coin. You must stop treating it as a lottery ticket and start seeing it for what it really is. A macro-sensitive monetary asset operating inside a liquidity-driven world. Part 2, the 4-year Bitcoin cycle. Why it worked before. For years, investors believed Bitcoin followed a perfect 4-year cycle. Halving happens, price explodes, then it crashes. This narrative became deeply embedded in the collective psychology of the market. Charts were drawn, timelines were projected. Entire strategies were built around the assumption that Bitcoin's behavior was predictable, mechanical, and guaranteed. Historically, this pattern did exist, but it was never a law of nature. Bitcoin halvings reduced the rate of new supply entering the market. Every 4 years, the issuance was cut in half. This created a supply shock in an asset with fixed total supply, and in theory reduced selling pressure from miners. But supply reduction alone does not explain what happened. At the same time Bitcoin was going through these halvings, the global financial system was operating under a very specific macro regime. Interest rates were persistently low, liquidity was abundant. Central banks were increasingly proactive. At every sign of stress, monetary authorities stepped in with rate cuts, asset purchases, and emergency support. This environment mattered far more than most investors realized. Cheap money encourages risk-taking. When capital is abundant and borrowing costs are low, investors move further out on the risk curve. Speculation increases, leverage builds, volatility expands. Bitcoin entered the market during the most aggressive period of monetary expansion in modern history. From the aftermath of the global financial crisis to the post-pandemic stimulus era, liquidity flooded the system. Risk assets thrived across the board. Bitcoin, as the most volatile and reflexive risk asset, thrived the most. In this context, the halving acted as an amplifier, not a trigger. It reduced new supply at the same time that demand was being artificially boosted. by loose financial conditions. Retail participation surged, narratives reinforced themselves, prices moved aggressively upward. The critical mistake was assuming that the halving itself caused the bull market. In reality, the halving only worked because liquidity conditions allowed it to work. Without abundant liquidity, supply shocks lose their power. Markets need marginal buyers. They need expanding balance sheets. They need risk appetite. When financial conditions are tight, capital preservation replaces speculation. Leverage is unwound. Volatility becomes a liability rather than an opportunity. This is why the 4-year cycle was never guaranteed. It was not a fundamental rule embedded in Bitcoin's design. It was a pattern created by a specific macroeconomic environment. Bitcoin did not exist in a vacuum. It grew up inside a decade defined by easy money, suppressed interest rates, and repeated interventions by central banks. The calendar did not drive the cycle. Liquidity did. The 4-year rhythm appeared reliable only because monetary policy remained consistently accommodative across multiple cycles. As long as liquidity expanded, the halving narrative held together. But once financial conditions change, patterns break. Without loose monetary policy, a reduction in supply alone is not enough to generate explosive rallies. Scarcity needs demand. Demand needs liquidity. The lesson is not that halvings are irrelevant. The lesson is that they are conditional. Bitcoin's cycle was never about dates on a calendar. It was about the global flow of money. And the calendar just happened to align. Part 3. Why the Bitcoin cycle is changing now. If you are still waiting for the next bull run to arrive on schedule, you may be waiting for a world that no longer exists. For more than a decade, Bitcoin investors believed in a simple rhythm. Every 4 years the halving arrives. Supply is reduced, price explodes. Then a brutal crash resets the cycle. This framework worked, not because it was a law of nature, but because the macro environment supported it. That environment is gone. Today, Bitcoin operates in a fundamentally different world. Interest rates are no longer near zero. Liquidity is no longer abundant by default. Central banks are no longer willing to stimulate endlessly at the first sign of market stress. For the first time in Bitcoin's history, it is being tested inside a tight and highly controlled monetary regime, and this changes everything. At the same time, Bitcoin's internal market structure has evolved. Institutional investors are now active participants. Spot ETFs have integrated Bitcoin directly into traditional financial systems. Pension funds, asset managers, hedge funds, and macro traders now influence flows. Bitcoin is no longer isolated from global capital cycles. It is directly plugged into them. As a result, Bitcoin behaves less like a pure speculative asset and more like a macro-sensitive instrument. When liquidity expands, Bitcoin responds. When liquidity contracts, Bitcoin struggles. When risk appetite rises, Bitcoin accelerates. When risk-off dominates, Bitcoin de-risks alongside equities, credit, and other risk assets. This shift is critical to understand. In the past, halvings coincided with an era of cheap money. Low interest rates encouraged leverage. Quantitative easing pushed capital outward along the risk curve. Global balance sheets expanded and speculative assets thrived. The halving reduced new supply at the same time liquidity flooded markets. That combination created explosive reflexive price moves. Today, the supply shock still exists, but the liquidity impulse is conditional, cautious, and policy-dependent. Central banks now prioritize inflation control over asset prices. Liquidity is injected selectively, not universally. Policy easing arrives slowly, unevenly, and often with constraints. This means Bitcoin's upside is no longer automatic. It must be earned through improving macro conditions. Cycles now stretch longer. Accumulation phases take more time. Rallies are slower to develop and harder to sustain. Volatility becomes asymmetric, sharp and fast during deleveraging, but more controlled and grinding on the upside. Many investors are still waiting for the old playbook to repeat. They expect parabolic moves simply because the calendar says it is time. But markets do not obey calendars, they obey liquidity. Applying an old map to a new world is a costly mistake. The more relevant framework today is not the halving cycle alone, but the interaction between risk-on versus risk-off dynamics, global liquidity trends, financial conditions, and the direction of monetary policy. If global liquidity expands meaningfully, Bitcoin will respond, not because of narrative, but because capital has fuel again. If liquidity remains constrained, no halving, no ETF, and no timeline can force a sustained bull market. This is the uncomfortable truth many investors avoid. Bitcoin has matured. and maturity comes with trade-offs. Less explosive cycles also mean less terminal fragility. Slower accumulation phases also mean stronger long-term foundations. Institutional adoption dampens chaos, but increases macro sensitivity. In this new environment, success does not belong to those who trade fastest. It belongs to those who adapt their framework, those who understand liquidity, those who track policy signals, not just price action, those who recognize that Bitcoin no longer lives outside the system. It now reacts to it. Bitcoin is not broken. The world around it has changed. And in this world, the winners will not be the loudest optimists or the fastest traders, but the most adaptable thinkers. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macrocycle Lab. See you in the next video.